Last class we did cost of capital, KD, irredeemable, redeemable, correct? Irredeemable formula is KD is equals to I into 1 minus T upon net proceeds, correct? For redeemable debt, what was the formula? I into 1 minus T, correct? Interest into 1 minus T plus RV, redemption value minus net proceeds upon N, the whole divided by RV plus net proceeds upon 2. Then we did, after that, we did in KD one more formula was there. When interest is given, only the percentage, KD is equals to I into 1 minus T. Then similarly we did for preference, KP is equals to dividend upon price, correct? For irredeemable preference shares. For redeemable preference shares, dividend plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds upon 2. Quickly you should go through it. Cost of equity. Cost of equity. First approach was dividend price approach, D upon P, correct? Second was dividend price plus growth approach, dividend D1 upon P0 plus G. Okay, in that formula I want you to be specifically remember, when I put D1 in the numerator, I will get P0. In Gordon's model, constant growth rate model, if I put D1, then denominator should be P0, because this formula is also related to perpetuity. If you remember the properties of the perpetuity in property, what we wrote for perpetuity gives us value 1 year back from the date of first installment, correct? 1 year back from the date of first installment. That is the property of PV of perpetuity's property, correct? Same way, if you put D1, okay, upon P, P0 it will be. If you put D2, which price you will take? P1. Are you understanding? See, if I want to write this, I can write it like this, na? Okay, this obviously it is not in cost of capital, it is not relevant what I am saying, but somewhere it will be. K is equals to what the formula I gave, D1 upon P0 plus G. If I rearrange this, it will become what? P0 is equals to D1 upon Ke minus G. If here it is D1, you will get P0. If here it is D2, what you will get here? P1, price of the first year. If it is D3, 1 year back from the date of first installment. This is nothing but similar. If you remember the perpetuity, there was no growth. Perpetuity sum, there was no growth. Every year 1 lakh installment was there. Now here what is the assumption? That 1 lakh every year or at 10% or whatever is the growth will grow till what? Perpetuity. Understood? Will grow till perpetuity. Correct? So, okay. Then what we did? Then price earning approach was there. K is equals to 1 upon P. That is E upon P. Earnings upon price. Okay. Then what we did? Realized yield approach, where we can apply what? The IRR method. If we have the cash flows, right, we will estimate the two discounting rates where the NPV is 0. That rate is called what? Realized yield in equity. Correct? I hope you are remembering this. Then what we did? CAPM, RF plus beta into RM minus RF. Correct? Right? And after this what? This was CAPM, capital asset pricing model. Why it is called capital asset pricing model? Because this rate will be used to price the asset, that is the shares. Therefore, it is called capital asset pricing model. Okay, we did CAPM. Okay. Did I tell you who gave this model? William Sharp. Who gave this model? William Sharp. Okay, there is something called a Sharp ratio also. So William Sharp, okay, Nobel Prize winner. Then after this, what we did? KR is equals to, yeah, SHARP. Sharpe. Sharpe. William Sharp. KR is equals to K. Cost of retained earning. If nothing is given, what? It's cost of equity. Why? Because this retained earnings, who are the owners of this retained earning? If it would have not been, if it would have been distributed as dividend, if it would have distributed as dividend, then shareholders would have invested it somewhere. So there is an opportunity cost. Okay. What is that opportunity cost? Required rate of return. Opportunity cost of equity shareholders. That is what? KE. Opportunity cost of the equity shareholders. Their required return becomes a cost for the company. That is KE. Today we are going to, you have to concentrate a lot. Today we are going to do very, very important theories and all. Okay. And it's quite important. The last part what is remaining is right heading overall cost of capital. Overall cost of capital or weighted average, weighted average cost of capital, weighted average cost of capital. This is remaining. This is denoted by KO, overall cost, or it is called WAC, weighted average cost of capital, or it is called what? WAC. Okay. Is it clear? What is weighted average? Weighted average of all individual costs. That's it. So KO is nothing but weight of debt multiplied by cost of debt into 1 minus T plus weight of P means preference multiplied by cost of preference plus weight of equity multiplied by cost of equity. Weighted average. That's it. Okay. Means weight should be multiplied by respective cost and then you have to take the total. It is not again multiplied. Please understand, whatever will be given in the question, either it will be before tax or after tax. Is that clear? Understood? If you have already considered, then it is after tax. Remember. Yeah, interest, if it is already multiplied by 1 minus t, then it is after tax. So you will not take. In the exam, what happens? Why I gave? I am not going to solve with this formula. I am not going to solve now the formula, means sums on this formula. I will be making a table. Understood? But in exam what happens? They specifically for 5 marks they might give you the weight of debt is this much, cost of debt before tax is this much. Directly they will give. Now you have to check whether it is before tax KD or after tax. If it is after tax, no need to multiply with 1 minus T. Are you understanding? Okay, so there I just gave you an idea because some might come where direct they will not test, but still you should know this thing. This is horizontal, I will be doing it vertically. Okay, the same thing. Question number 43. $255. The following figures were obtained. Page 255. Please open. Question number 43. The following figures were obtained from the balance sheet of X Limited. 12% preference share capital, 12% debentures, equity share capital 20 lakhs. The finance department also report the following cost of capital 7.2 is KD. Okay, they have not mentioned, so we will assume it is before tax if tax is given. What we will assume? It is before tax. KP is 12%, KE is 25%. calculate the weighted average cost of capital. Weighted average is what? Weighted average cost of capital we will calculate. So we will have to calculate what? Weights, and then weights multiplied by respective cost. Listen carefully. Tax is not given, that means it's after tax. If it is given, you have to assume it before tax. Understood? Okay, listen. First, let me calculate. Solution. Calculation of WACC. That is KO. Source. Okay, make a table. Amount. Now what we are using is book value. So I will write book value. Cost. And then amount multiplied by cost. Okay. So source. First source is what? Preference share capital. So I will write preference share capital. Please tell me the amount. 20 lakhs. Correct? Cost is how much? 12%. Understood? It is given 12%. Next is what? 12% debentures. 12% debentures. 10 lakhs. How much is the cost? 7.2%. It is given. Equity share capital. 20 lakhs. 25%. Take the total of this. Total of the amount column is 50 lakhs. 20 lakhs into 12% is how much? 2 lakh 40,000. 10 lakhs into 7.2% is 72,000. 20 lakhs into 25% is how much? 5 lakhs. Total is how much? 8,12,000. Listen carefully. KO, WACC is equals to total cost. KO, WACC is what? Total cost upon total capital. This is your total cost. This is your total capital. Total cost is 8,12,000. Capital is 50 lakhs. Is equals to 1624, or I can say 16.24%. Please copy. Easy. Everybody understood? We are just calculating what? Weighted average. Okay, please copy. Is it completed? Can we proceed? Yes. If you have done, listen. This alternatively, this can be calculated how? Listen. Now here what happens? I can calculate the weight. Please understand. Alternatively, what I can do is I can calculate the weight. How I will calculate the weight? This 20 lakhs divided by total is how much? 20 divided by 50 is how much? 20 divided by 50. 4, 0.4. And 10 divided by 50 is 0.2. Again, this is 0.4. So these are the weights. Listen carefully. These are the weights. Alternatively, yeah, into K. Now in exam, you will not get exact 0.4 and all. So to skip that rounding off error, we are doing the first method. In first method, it's foolproof. You will get guaranteed answer. No rounding off will be there. Okay. Now here what happens? If it is not exactly 0.4, then you will have to take 4 digits and all. So it becomes very tedious. Now K is how much? 12%. 7.2%, 25%. Please multiply W into K. Please multiply 0.048. Okay, next 144. Next 0. Acha, this is acha. You are taking in correct. Don't take in decimal. Take it in. Yeah, this will be 4.8 like this. 12 into 0.4. Like do like that. 7 point into 0.2. Correct. She was right. Okay, do it like that. How much? Second one. 1.4. Next. 10. 10. So 10, 14. How much is the answer? Check. How much you are getting? Yeah. 16 point? 7.2 into 0.2. Yes, it is 1.44 here. 1.44 plus 4.8 plus 10, 16.24%. 16.24%. See, is it same? Yes. What we did? This was weight of preference multiplied by cost of preference. Weight of debt multiplied by cost of debt. That is what the formula I have given above. Weight of equity multiplied by cost of equity and then the total plus. So isn't it the same? That's the same thing what we are doing. Please copy this alternatively. Copy this alternatively. Write alternatively. Yeah, one by one. Yeah, say. Wrong question. A math student should understand. Listen carefully. This is the drawback of the variance. What we calculate. Variance is in what? Percentage square. If this 0.4, we are not taking 12% of 0.4. 12 is in percentage. If you take 0.12 na, then again I'll have to divide whatever the, if I take this, all these figures in decimal, understood, then I'll have to convert again. I'll have to do into 100, then I will get in percentage. So instead of that, whenever in maths, whenever, where previous formula? This, na? So where I didn't say yes, where I didn't say the first was not multiplied. I'm telling you for your convenience. For your convenience, listen carefully what I'm saying. Basic maths, listen carefully. Whenever there is two things, both in percentage, take one in decimal, one in percentage. The final answer will be in percentage. It will be a problem for you. CA final we do. We take one thing in, both two things are in percentage. Take one thing in decimal, take another thing in percentage. Understood? So the final answer will be in percentage. If you take both decimal, answers will be same. But again you will have to multiply with 100. So why to do all those things? Take one thing in decimal, take another thing in percentage. And those who have pressed like this, na, 0 point into 12% on your calculator, wrong. 12, everything is in percentage. So 12 just multiply by 0.4. It is how much? 4.8. Done. Yeah, exactly. But what happens? The foolproof method is the first one, because here though in our example weights are you are getting exactly means point 0.4, point 0.2. There, if these are market weights, na, instead of book value, if they give you the market cap, means market value of all these things, then you will not get exact rounded figure. There will be rounding off. So at that time, not to means why to calculate in decimals and all. This is very safe method. This is a very foolproof method. This one. Okay, fine. Listen, in the previous question, what we used, listen carefully, what we used is book value as weight. Here we used book value. See, amount in book value. Okay, I'm asking you, if the market value is available, what should be used? Book value or market value? Book value or market value? Market value is saying. Is it correct? Why market value? Why? Why market value? What may be the reason? So, what he means to say is the market value is the present position. It's correct, but market value though will keep on changing. Will keep on changing every day. How you get the market value? Number of shares multiplied by market price. Correct. So, but the market price though will keep on changing. Correct. So every day you will calculate back. So what happens? Actually, listen. Practical life. The weights should be based on target capital structure. Target means where you have to reach. But in our exam, target capital structure is not given. So either book value will be given, market value will be given. But market value, practically I am saying, practically means which is the more accurate way, which is the more accurate way which is based on market value. Agreed. But practically you can't use it. Why? Because market value keeps on changing. So you generally use book value. Ideally, you should use target. Target means what? What will be the structure of the company in the future? Are you understanding? That is target capital structure. Those weights should be used. Means those figures should be used. Target. In our exam, just for the sake of knowledge, I am saying. Is that clear? In our exam, they will not give us target capital structure. They will give us either book value or market value. Practically, if you want the accurate figure, na, it should be based on market value. Very right. But market value keeps on changing. So what we use? Basically, we use book value. Okay. Coming to the textbook. In the above calculation, 16.24 is the weighted average of 12%, 7.2%, 5%, where the weights are used as book value of different components. And it is also argued that when individual component of capital are determined on the basis of the market value, this is the reason. Individual, when I calculate the cost of preference, what I use? D by P. Now what is P? P is the current market price. Understood? When I use KE, D1 upon P0, P0 is what? Current price. Then when individual costs are calculated on current price, then why the overall weight is calculated on book value? That is the argument. Correct? Is it clear? For the purpose of determining weighted average cost of capital, a question arises that what should be selected as weight. The answer can be either book value or market value. Argument in favor of market value. Listen. For determining the individual cost of capital for each component, the market price are considered, market values are considered. Have you understood what I am saying? When you were calculating, the individual cost, what you used? Current market price, no? Correct? So what should be used here? When we are calculating the overall, you should use what? the market value as the weights. Therefore, in order to determine the true, accurate overall cost, weighted average should be determined on the basis of market value. It is also stated that market value is more realistic as against the book value basis, which is theoretical, which is past. Hence, market value basis is more appropriate. Understood? Practically, it is more realistic, more practical. Argument in favor of book value. It is argued that market value does not remain stable. Every day the market value keeps on fluctuating, market price. Therefore, the use of market value as a basis of for determining the WACC will be unreliable and inconsistent. Frequent changes in the cost of capital may adversely affect the decision making process. If continuously you are keeping on changing your figures, what will happen? You will not arrive to the decision in the long term. Therefore, using book value as the basis will provide consistency in determining the overall cost of capital. Hence, it is the more appropriate base. Okay. So, what is the conclusion? On objective basis, it cannot be concluded which is more appropriate. You can't. It would depend on different circumstances that what should be used. Okay. As a overall cost of capital, what should be the basis of it? It will depend situation to situation. Is it clear? Understood? Question number 44. Question number 44. What would be your answer in question number 43 if weighted average cost of capital is to be calculated not on the basis of the book value but market value? For this purpose, the following information is available. See, each equity share, for your knowledge, equity share has a face value which is used to calculate the dividend. It has a market value, how much? 16 per share. When the market price is multiplied with number of shares of the equity, what we get? Market cap. What we call market cap, market capitalization. Okay. So 16, that is the price multiplied by number of equity shares, will give you market cap or market value also. 125 is the market value of what? Preference. 87.5 is the market value of debenture. Okay. So these are given numbers we can get from the previous question. Correct? Tell me the numbers from the previous question. What is the face value for the preference given? Check. Divide by 100. So how much it is? 20,000. Correct. You should write this. Divided by face value is how much? Debenture 100. Correct. 10,000. 20 lakhs divided by 10, na? Right? So it is 2 lakhs. Okay, these are the numbers. Okay. Cost is also given in the previous question. Let's start. Listen. Question number 44. Calculation of KO, that is WACC, using market value as weights. Source, amount, K. Wait, let me elaborate this. Otherwise, number, market price, then amount, then K, and then amount into K. Source is what? Preference share capital. How much was the numbers? 20,000. Correct. What is the market price? 125. So answer is what? 25 lakhs. 12% debenture. 10,000. Price is what? 87.5. So when I multiply, what I will get? 8,75,000. Equity share capital. How much? 20,000. No, 2 lakhs. What is the rate? 16. The answer would be 32 lakhs. Take the total. Total of amount column. 65, na? 3 plus 2, 5. 65 lakh 70. 65 lakh 75,000. 65 lakh 75,000. Cost of debt for preference it was 12%, 7.2%, and here it is how much? 25%. 25 lakh into 12% is how much? 25 lakh into 12%. This time you should press percentage because we are calculating the amount into, not weight. How much? 3 lakhs. 8 lakh 75,000 multiplied by 7.2%. 63,000. 32 lakhs into divided by 4. 8 lakhs. 8 3 11. 11 lakh 63,000. WACC, KO, overall cost of capital is what? Total cost divided by total capital. Total cost divided by total capital. Total cost is 11 lakh 63,000 divided by 65 lakh 75,000. What is the answer? Yes, 17.69%. Yes. What? Book value is calculated on face value, huh? Interest, huh? Interest. Where we are calculating interest? Hmm. Array, we are not calculating the returns. Please understand. Please understand. This is the cost of raising the debt. This is the cost. Cost is different. Coupon is different. Coupon is what? What the company pays to the investors. Not necessary. This is YTM. Remember. This is YTM. Remember. YTM is different. You remember in one of the lecture I said coupon is different. Interest rate is different. So you should make a habit of not saying interest. You should make a habit of saying coupon. This is the discounting rate. Understood? So I clarified there itself. Is it okay? If nothing is mentioned, listen. If nothing is mentioned, if you want to go ahead, I can say that means when nothing is mentioned, what we do, how we calculate the cost of debt. Understood? 12 into 1 minus T means what? 12 coupon only we take. We assume that that itself is YTM. Okay? And chalo, let me explain. When KD, cost of debt or YTM is equals to coupon rate, this means you are assuming that your bond is trading at par. Your bond is trading at par. Please understand, coupon is different and YTM is different. Till this point, wherever I couldn't find the YTM, I assumed that coupon rates itself is YTM. That is the KD. But here in this question, it is separately given 7.2. Understood? Now, one more argument I can say that 12% is before tax. They might have deducted the tax and then they might have given this. Is it clear? Okay. So, this done, correct? Right. Acha, listen. Retained earning, retained earning. If it is given separately, should it be considered or not? If it should be considered, when it should be considered and when not? Retained earning. When should be considered? In every case, For whom? Yes, exactly. Very good. Retained earning, if you are taking market value, the weights are based on market value, then you should not consider the retained earning. Understood? Why? Because two arguments are there. One is retained earnings are not saleable instruments. Agree? Okay, very loose talk. Retained earning and intellectual talk is what? How you arrive to the market price of the equity share after considering the retained earning. Market price reflects the status of the company. Is that clear? So, are you understanding what I am saying? Market price when you arrive now, it has already considered the retained earning. So, no need to consider it separately. Okay. So, write a self note. Write a self note. Write a self note. While using market value as weight, market value as weight, while using market value as weight, comma, do not consider, do not consider retained earnings, do not consider retained earnings, do not consider retained earnings because retained earnings, retained earnings, retained earnings, because retained earnings are not saleable instrument, are not saleable instrument. So market price is not available. It's not saleable, so market price is not available. Okay. And and more importantly, and more importantly, and more importantly, the value of retained earning, the value of retained earning is included in the market price of equity, in the market price of equity. Two arguments. One is retained earnings are not saleable, you can't sell it, so market price is not available. Second thing, more importantly, what happens is market price is arrived after considering all this retained earnings. Okay, done. Question number 46. Please try this. Question number 46. Please try. in the question number 46. Okay, K is not available, cost of equity, but the information is given. Current dividend per share is 24. Growth rate is given. From that growth rate, I come to know what? That I should apply Gordon's model. Okay. So current dividend means D0 is given. Okay. So D0 into 1 plus G will give me what? D1. Current market price. So this answer should be 24 into 1.15 should be how much? 27.6. 27.6 divided by price is 240 plus growth should be in decimal 0.15. Answer is how much? 26.5%. 26.5%. So this is K. Okay. This is K. KP is how much? KP. Nothing mentioned. So I will take 12%. Nothing mentioned. So I will take 12%. Remember. Okay. KD is how much? See, once again. KD. They have not said anything. So coupon rate, that is 18, multiplied by interest multiplied by 1 minus T, 1 minus 0.5 will be 9%. So KE I got, KP I got, KD also I got. Okay, now I can calculate what? They are saying us calculate the weighted average cost of capital by using book value, basis of book value and basis of market value. So calculation of WACC based on book value. Source amount K, amount multiplied by K. First is what? Equity. Equity share capital. Equity share capital. Face value is 100. 100 multiplied by 10,000 will be how much? 10 lakhs. KE was how much? 26.5%. Okay, so answer is 2,65,000. After that, equity was given. Retained earning is given. So we will have to take retained earning. Retained earning is how much? Retained earning is 20 lakhs. Retained earning is 20 lakhs. So 20 lakhs. What will be the cost for retained earning? KE, that is 26.5%. If nothing mentioned, then KE. If it is mentioned separately, take that. 26.5% into 20 lakhs. 2 lakh 30,000. 5 lakh 30,000. 5 lakh 30,000. Okay. Preference share capital. Preference share capital is 20 lakhs. So I will take 20 lakhs. 12% is KE. 2 lakh 40,000. 18% debt, debenture. 18% debenture is 30 lakhs. 30 lakhs into K is how much? 20? No, debenture 9%. So 2 lakh 70,000. Okay, take the total. Here 13 lakh 5,000. And this is how much? 40, 50, 80. 80 lakhs. 13 lakh 5,000 divided by 80 lakhs. How much? 3125%. 16.3125%. Done. Next, calculation of WACC using Market value as weight. Source. Amount. K. Amount multiplied by K. Number of equity shares is, equity share capital is first source. Number of equity shares is 10,000. Market price of equity share is how much? 240. So 10,000 multiplied by 240. 24 lakhs. Okay, KE will be 26.5%. I will not take retained earning. Remember, retained earning will not be taken because weight is what? Market value. So should not be taken. Preference share capital. Preference share capital. Market price of preference share is 100. So face value is also 100. So it will remain same, 20 lakhs. Okay. Now nothing mentioned means it is 100. Okay, it is not mentioned, na? So face value is 100. Anyways, market value is also 100. Debenture. Where it is given? Face value of the preference is 100. Correct. It is given. And market value is also 100. Okay, no problem. It is given. Right. Acha, what is the face value for the debenture? Nothing mentioned. And market price also not given, right? No. Okay. So debt, same debenture will be how much? 18% debenture will be how much? 30 lakhs. Preference share capital is 12%. This was 9%, I think, right? This will be 2,40,000 and this will be 2,70,000. 24 lakhs into 26.5%, how much? 6,36,000. 6,36,000. Here the total is 5, 6, 7, 74 lakhs. 7, 14, 4 carry up 1, 7, 9, 11. 11 lakh 46,000. Whack. 11 lakh 46,000 total capital divided by 74 lakhs. How much? 15.48%. Is it correct? 15.48%. Okay. This is what, there is a particular mix in this, correct? Equity proportion should be this much, preference should be this much, debenture should be this much. A company might have some target that this much should be the proportion of equity. That is called target weights. That is called target weight. What the company have to maintain. That is called target weights. Remember, but target weights are generally not given. Okay, in practical life it will be, you will get it. Realistic, which is more realistic? Market value. Okay, but practically not possible because the figures will keep on changing. Okay, so you can't rely. Therefore, what? Book value should be used. Done. Right. Heading. Marginal cost of capital. Marginal cost of capital, MCC. Marginal cost of capital, MCC. What is marginal? When we say marginal, marginal means what? Additional. What is the cost? What is the extra cost, additional cost to raise 1 rupee of capital? To raise 1 rupee of capital, correct? Economics. What is marginal utility? Additional utility derived from intake of one unit. Listen carefully what I am saying. Those who know, please listen. Those who know, they also listen. Those who don't know, they also listen. What is marginal? Marginal means additional. Marginal means additional. Here what will happen? The cost, the additional cost of raising a rupee is called what? Marginal cost of capital. Okay. Generally it is calculated using target weights. Generally it is using, because target means what? Your structure is going to change. Marginal means what? Additional debt you will issue, additional equity you will issue. Right. Write a note on this. Right. Marginal is defined as MCC. Right. Shortcut. MCC is defined as cost of raising cost of raising additional additional rupee of capital. Spelling is wrong. Additional rupee of capital. Done. Right, next line. Marginal weights, that is target weights are used to calculate MCC. Think and tell me if the cost, that is KD, KE, does not change and the proportion is also constant. Proportion means what? Weights. Can I call MCC as WACC? Previously, what was the cost? KE, KD, KP. This is constant. Previously, what were the weights? They are also constant. By multiplying this, we used to get WACC. Correct. What is MCC? Additional. Please understand. The cost of raising 1 additional rupee. So my question is, if these all things are constant, if this is also constant, can I say WACC is nothing but MCC? It's same. Because the proportion is same. That means there is no addition. The cost will be same. Correct. What is the addition? If your WACC was 18%, that means now also the MCC is also 18%. It's same. Write this. What will write? When? So, yes. Concept will be that because they, but it is also, listen carefully, the additional cost now of raising the fund is same as WACC. Understood? Means what they mean to say is, no, write first. When firm raises, please write. When firm raises fund, when firm raises fund in proportional, when firm raises fund in proportional manner, and component cost remains unchanged. Component cost remains unchanged. There will be There will be no difference. There will be no difference between average cost of capital, average cost of capital and MCC, average cost of capital and MCC. Please understand, there is a thin line. Please understand what I am saying. See, you have raised a fund, extra 10 lakh rupees. Please understand, extra 10 lakh. But the proportion is same. Understood? When I say when the firm raises the fund in proportional manner. Understood? Means 10 lakhs. Proportional means you understood what I am saying. In the same weights means 10 lakhs is distributed. Like let's say, please understand, let's say your weight of equity, weight of debt, weight of preference, or ignore preference. Let's say the weight of equity was 50 and debt was 50. Understood? Weight of equity is 50 and debt is how much? 50. Please understand. I am raising 10 lakhs, but I am raising in the same proportion. 5 lakh here, 5 lakh here. That means weight is same. Correct? Cost is also same. Cost is also same. KDK, no change. That means whatever is the WACC, whatever is the WACC is what? Additional cost. Additional cost means what? Means you don't think like it is a minus. There is no increase, I agree. But if I ask you, if let's say your original WACC was 18%, if I ask you what is the WACC, you will say 18%. What is the cost of raising 10 lakhs? What you will say? 0? No, it is 18. Please understand what I mean to say. Okay, means what? Additional is 0, MCC is 0. But if they ask that what is the extra cost you have incurred or what is the cost, you can call it as 18%. Means MCC is almost same. And in international FM, finance, alternatively these words are used. Please understand. Sometimes questions come. Okay, like I am teaching in one of the University of Toronto. So University of Toronto, they don't use WACC. Okay, they use what? They call WACC as also what? Marginal cost of capital. Understood? So in exam also it might happen. They will ask you what? It has happened in CA also. That they have asked marginal cost. Marginal cost means what? They are asking you the WACC. If there is no addition. If there is no addition and they ask you the MCC, that means they are asking you WACC. You can't write there that since this is additional cost is 0. Understood? So MCC is 0. No. What is the cost? The cost is 18%. What is the cost of raising the additional debt? 18%. It remains the same. What? If it is in different proportion, then the MCC will be there. Then the MCC will be there. It will change. Okay, that is what we are going to do now. Question number. Check question number 50. Question number 50. 50. See the question. The existing capital structure of NJ Limited is given below. Equity share capital, share of 100 is 20 lakhs, retained earning 10 lakh, 12% debenture, how much? 10 lakhs. Cost of the finance department reports KD is equals to 8.4% after tax. Okay, KD is given after tax. See, clearly they are mentioning. K is how much? 18%. The company requires additional fund of 10 lakhs for which it is planning to raise 14% debentures where the post-tax cost of debt for this debenture will be 9.8%. The company requires additional fund. How much? 10 lakhs. How it will raise? By issuing 14% debentures. Okay. And what is the cost? 9.8% after tax. With the issue of this debenture, it is expected that the rate of return expected by the equity shareholders will increase. Very good point. Very good point. Will be applicable in all the theories. What I am saying. Okay, listen carefully. When the company issues more debt, they are saying the cost of equity will go up. Why? My question is why?
It increases the risk.
Very good. So there are, one is traditional approach, one is net income approach. We'll come to that. But some school of thought, what they say, they say equity shareholders will not increase their expectation. Is it practical? No. So the MM approach came, Miller and Modigliani, net operating income approach, where they talk about what? I'm diverting. This has nothing to do with the question. I'm just building my base. Please understand. What I'm saying is, obviously, when the debt increases, the risk of the equity shareholders increase, and therefore their expected return will increase. Equity shareholders' expected return is cost for the company. Therefore, KE increases. So that the revised KE will be 26%. First, what we will do, listen carefully. First, we'll calculate the current WACC. Okay, let us calculate the current WACC without the additional fund. Please, you can do it. Calculation. Come on. Calculation of WACC at present. Calculation of WACC at present. Source. Amount. This time it is book value. K. Amount multiplied by K. I think this is more convenient. Don't you feel? Instead of calculating all those weights and all. I think so. It's your call. 12% debenture, 10 lakhs. K is how much? Debenture 8.4 presently. 84 lakhs, 84,000, sorry. Then equity share capital, 20 lakhs, 18%. So it will be 18, 360, 3 lakhs 60,000. Preference share capital is also there. No, preference is not there. Retained earnings is there. Yes, retained earnings. How much it is? 10 lakhs. What will be the rate? 18%, same. Okay. 1,80,000 total. 40 lakhs. 6,24,000. Back. 6,24,000 divided by 40 lakhs.
15.6.
15.6%. 15.6%. Calculation of WACC. After that, additional financing. After additional financing. After additional financing. Source. Amount. K. Amount multiplied by K. 14% debenture. This was how much? 10 lakhs. 9.8%. The new one. So it will be 98,000. Then the current structure, that is 12% debenture was there. 10 lakhs. 8.4%. 84,000. Equity share capital 20 lakhs. 26%. Remember, this time it should be 26 because it is going to go up because of the debt. How much it is? 5 lakh 20,000. Retained earning 10 lakhs. 26%. 2 lakh 60,000 total. 30, 40, 50 lakhs.
9 lakhs.
9 lakh 62. 9 lakh 62,000. Whack.
19.8.
9 lakh 62,000 upon 50 lakhs. 19.24%. 19.24%. What is marginal? Math student. Differentiation. What is marginal? Is differentiation. Differentiation of what? Of the cost to the capital. If you can understand. Formula wise. Marginal cost of capital is increase in cost. Increase in cost upon increase in capital. What we are doing? Differentiation. Increase in capital. Cost was how much? 6 lakh 24. 9 lakh 62,000 minus 6 lakh 24 divided by 50 lakhs minus 10 lakhs. How much? Sorry, 40 lakhs. 50 lakhs minus 40 lakhs. How much it is? 0.338, or I can say 33.8%. The cost of raising 1 rupee is how much? 33.8%. Done.
Yes, sir.
Come to question number 58. Question number 58. Read this question. Try to solve. Start. Are you comfortable with the question? They have not given us the KD and all. Correct. They are asking us to calculate. So in the question, debenture is carrying how much interest? 16%. Okay, and current market price is given. Tax rate is given. So what I can do? I can calculate what? KD. Okay. How I will calculate KD? Listen. 16 into 1, 16. 16 will be same. 16 on 100. Because the price is 96. That means my face value is 100. We have to understand that. Is that clear? So first I will calculate what? KD. First thing in the question, what they have asked? They have asked us cost of new debt, cost of new preference shares, means cost here, new debenture. Okay, cost of new preference share was also issued. This cost of new equity share, assuming new equity from retained earnings. Marginal cost of capital when no shares are issued. See, marginal cost of capital when no shares are issued. Determine the amount that can be spent for capital investment before new ordinary shares must be sold. Assuming that retained earning for next year is investment are 50%. Retained earning is how much? 50% of 2017. Compute the marginal cost when funds exceed the amount calculated in C. Assuming new equity is issued at 20 per share. Let's go through the question. Those who have not understood, listen. Currently the capital structure is this. Currently the capital structure is this. The company's share price is currently this 23.6. Next year's dividend per share is 50% of the year 2017 EPS. 2017 EPS is this 2.36 into 50% is how much?
1.8.
So your dividend is 1.18. Next year's dividend. Listen carefully. The trend is showing that EPS for the preceding 10 years, which is expected to continue in the future. Okay, if you remember, I gave you a note in Gordon's model. When nothing is mentioned about the growth, what we do? Growth in price, growth in dividend, growth in earnings is same. Correct? So how much is the growth in price EPS here? 10%. Check. Here, how much it is? From here to here, 1.1 to this is 10%. Please understand. If you are unable to calculate, what you should do? 1.10 divided by 1. That is this divided by this minus 1. You will get 0.1. That is what? 10%. Then you should check 1.21 divided by the previous one. 1.1 minus 1. Whether you are getting 10%. Correct? See, add 10% to this. 1.95 plus 10%. How much it is? 1.95 plus 10%.
2.145.
2.145 means almost 2.15. Means here also the growth is 10%. Means constantly the growth is how much? 10%. Therefore Gordon's model to calculate KE. Now then they have given us the information that new debt will be issued at this rate. Let us go slow. First question is what? Cost of new debt. Let us calculate that. Cost of new debt. Let us calculate that. First note, right? Cost of new debt. Cost of new debt. This is question number what? 58. Cost of new debt is equals to I into 1 minus T upon price or net proceeds. Correct? So I is what? 16%. 16% of 100 is 16. 1 minus tax rate is 50%. 0.5 divided by what is the price? 96. Please tell me the answer. 8 upon 96. 8.33%. 8.33%. Second, please copy, do it with me. I hope everybody is doing. Cost of new preference share. Cost of new preference share. KP will be what? P upon P0. Correct. They have not mentioned. See, preference share rupees 9.20 with annual dividend of 1.1 per share was also issued. They are not saying anything about the life and all. So D upon P0. Irredeemable. Irredeemable. Dividend is how much? 1.1. Price is how much? 9.2. Answer
9.
11.95. 11.9596%. Okay. 11.96%. Next. Third question, what they are asking? New equity shares. Assuming new equity from retained earning. Okay. That is the growth you have to consider. That is the meaning of that. Okay. So K is equals to P1 upon P0 plus G. EPS of 2017 was how much? 2.36. Therefore, dividend of 2017 will be 2.36. They are saying 50%. So 50% will be the dividend they are saying, correct? Right, the company next year dividend is 50% of 2017's EPS. Next year means D1 it is. Remember, so 1.1 it is what? D1. Don't give the growth, please remember. So price is how much of the new equity share? I can't find. I couldn't find. Yes, below the company's share for market price is 23.60. Correct. And growth we know 10%. Okay. Growth is equals to 10%. That also I will write. How? 1.1 divided by 1. Okay. From EPS. No need to show the working of the growth. How you calculate it? D1 is how much? 1.8. Price is 23.60 plus growth is how much? 10. So 0.1. Answer 15%. Exact 15%. Great. Next. What they are saying? Calculation of marginal cost when no new shares are issued. See, they are using that word. When no new shares are issued means existing WACC. Underline that. Underline and write WACC. Alternatively, it is being used. See, there is exam question, I think. This is a question from the module. This is not exam question. It's a exam. It's a from module. Calculate B part. Calculation of MCC, that is WACC, when there is no new shares issued, right? Source, amount, K, amount into K. Okay. First equity first was what? Debenture 8.33. Debenture 8.33. From the question, 14% debenture. 14% debenture. 14% debenture. What is the amount? 30,000. 11% preference share. Capital 10,000. Same from the first table I will copy. Equity share capital 1,60,000. So the total is how much? 2 lakhs. Debenture cost was how much? Please check and tell me debentures cost was how much? 8.33%. Preference cost was how much? 12%, na? 11.96. Okay. 11.96. And preference was how much? Sorry, equity was how much? 15%. Please give me the amount. While taking 33, take full 33 in 8.33. Okay. 30,000 into 8.333%. So it's coming to 2,500. Take full figure 2,500. 333 recurring on your calculator. 10,000 into 11.96%. 1196. 1,60,000 into 15%. 24,000. 27,696. MCC or WACC is equals to 27,696 divided by 2 lakhs. Answer is how much? 13.85%, 848, that is 85%, 13.85%. Please copy. 13.85%. Listen carefully now. Listen carefully. What we learned, if you have to keep the MCC constant, that is WAC constant, please understand, WAC constant, and you don't want to issue anything, new shares, okay, then the proportion should be the same and the cost should also be the same. If you don't want to increase the MCC and keep the WAC constant, what? The proportion should be same, and what? The cost should be constant, that is the KD, KE, or everything should be constant. That is what we learned. Listen, in the next question, what they are saying, determine the amount that can be spent for capital investment before new ordinary shares must be sold. Okay, assuming that retained earnings for next year is 50% of 2017. Okay, listen carefully. C, na? C, C. Listen. Keeping what? Cost of capital constant. Okay, now listen carefully. Keeping cost of capital constant. Okay, what we can do is, how much money is available with me? Check retained earning, retained earning. How I will calculate retained earning? Retained earning. The number of shares is how much? Equity shares.
10,000.
10,000. Number of equity shares is 10,000 multiplied by EPS is how much? 2.36. Out of this, 50% I will retain. Means 50% is money with me. Are you understanding? Okay. Total my earnings is how much? 23 lakh 36,000. Sorry, 2 lakh 36,000. Out of that, 50%. Did I? No, it is not. Acha, 2.36 na. So it will be 23,000. 23,600 is my earnings. Out of that, 50% will be how much? 11,800. Listen, the proportion needs to be same. What I am saying? Proportion needs to be same. Copy this first. Copy this much first, please. Acha, it is 23.6. Okay. This is 23.6. Please correct it. Yeah. No, it is 2.36.
2.36.
See. Array EPS it is 20. Correct it was. 2.36. I'm not calculating market price. Retained earning. EPS is how much? 2.36 multiplied by 10,000. 23.6 is market price. 50% we will retain. Means 11,800 we have retained. Done. Listen. Weight of equity. Weight of equity previously was how much? 1,60,000 divided by 2 lakhs. 1,60,000 divided by 2 lakhs will be how much? 0.8. 0.8. That means 80%. That means 80%. Correct? So listen. So what I will calculate? This 11,800 is nothing but 80% of total capital. 80% of total capital. Please understand what I am saying. 80% of total capital. Please, very technical point. Very technical point. Understand. If I divide this 11,800 with 80%, you remember, if you have the figure of anything and you have the percentage of that, you can get 100%. Yes or no? So total capital is equals to how much? 11,800 divided by 80%. How much it is? 14,750. Understand? Out of 14,750, please understand, 80% will be financed by what? Equity. Equity means retained earning. Without issuing equity, retained earning is also part of equity, na? Is that clear? So 11,800 will be financed by what? Will be financed by retained earnings. You can make capital investment of how much? 14,750. Please understand. Out of that 80%, okay, how much? 11,800 will be funded by what? Equity, that is retained earnings. The remaining money will be funded by whom? By 14% debenture, by preference share capital. In the same proportion. In the same proportion. Is it clear? Okay, so proportions will remain same or will it change? It has to remain same. If the proportion is same, if the cost is same, will the WACC change? No, that is what I was emphasizing there. So that is what you have to do. So without any additional issue of shares, without changing the WACC, how much you can raise? That is 14,750 capital investment you can make. Okay. Without issuing equity shares. Without issuing equity shares. Please copy this. Done. See the next question. What they are saying. Now listen carefully what I am saying. Listen. If you make more investment, more than what? 14,750, then you will have to issue the equity share. You will have to issue what? Equity share. And when you will issue the equity share, okay, what will happen? Your cost will change. And hence there will be additional cost, that is marginal MCC, marginal cost of capital. So they are saying in D part, compute the MCC. I hope it is clear, this previous part. Everybody clear? Say.
Things they are given in the textbook, I did not understand.
Which one?
See,
The amount that can be spent, how much you can spend? This much you can spend without issuing what? Without issuing the ordinary shares. Ordinary means equity shares. Without issuing any equity shares, how much is the retained earning? 11,800. My additional cost should not go up. Additional cost should not go up. So 80% of the funding will be done by what? Retained earnings. 80% from where I got? Previous weight of equity. This. The remaining amount, the difference between 14,750 and 11,800 will be funded by what? Debenture and preference share. So the proportion would be the same. The cost is same. So there will not be additional cost of capital. Is it clear?
before ordinary is what?
Ordinary shares means what? Ordinary shares means what?
Equity.
Equity shares. You can't issue equity shares. means equity share should not be issued. But if your capital investment goes above this, exceeds this, then what will happen? You will have to issue the equity share. Understood? Now listen, in the next question, we are coming to that. Compute the MCC. Others, is it clear what I said? Which one? This part. Equity can't be issued. Listen now. Either you tell me you want to make a capital investment. Either you should have the money or you should have reserves and surplus. Isn't it? So there is reserves and surplus. How much? There is retained earning. How much? 11,800. You don't want to increase your WACC. So what is the condition? What is the condition I said? When the WACC will be same as MCC? When? When it is issued in the same proportion. So out of 14,750, this is 100% capital. If you issue this much, if you are making a capital investment of 14,750, no new equity needs to be issued. Out of this, 11,800 will come from where? From the retained earning. The balance amount will come from where? Preference and debt. So my question is, will your proportion change? Will the weights change of investment? No, no. You will issue the difference. Tell me the difference. Tell me the difference. 14,750. 2,950. What was the weight? What was the weight previously of the preference and debt? Please check. 30 divided by 20. 30 divided by 200. It's 15%. And this is 5%. This is 15%. This is 5%. Correct. Preference is 5%. So 15% will come from debt and 5% will come from what? From preference share. Okay, there is no requirement to issue equity share. Is it clear? Understood. And your cost will also be constant. Understood now? 15%. Yeah, 15, sorry. 15% of 4750. Right. Please give me the figures now. 15% of 14,750. How much? 2212.5. And 5% of 14,750 is how much? 737.5. This total will come to how much? That is what we recently calculated now. The difference. How much? 2,915. 15, na? 50. 2,950. See, same. Okay. And the remaining from the retained earning. So every capital investment is coming from different sources. No equity is issued. And your cost will also what? Remain constant. Okay. So coming back, listen. Next question. If your capital investment exceeds this means which amount I am talking about? 14,750. 14,750. Please understand. 14,750. Understood? Then see what they are saying. Calculate the MCC when funds exceed the amount calculated in C. Assuming new equity is issued at what? 20 per share. The price has changed. So my question is, will the KE change? Yes or no? Now the KE has changed. See, the KE has changed. So I'll have to calculate the KE. KE is equals to D1 upon P0 plus G. My dividend is same, 1.18. But the P is how much? Price, 20. My growth was how much? 10%. Please calculate how much it is. What is the KE? 10.59. 15.9. 0.159, or I can say 15.9%. How much was your KE previously? 15%. So now I am asking you, will the WACC remain same or will it change? It will change. It will change because of the new equity when you will issue. New equity when you will issue, obviously the weights will also change and the KE also changed. Okay, let's start. So they have not said that how much amount to be issued. Okay, They are just saying that it exceeds. What they are saying? It exceeds. So let us continue. D part, calculation of what? MCC. Calculation of MCC. Listen. Source. Instead of amount na, I will write what? Or I can write the amount also. What was the debt amount previously? 30,000 na? And preference share capital? 10,000. Equity they have not said how much. Equity they have not said how much. So I will take the same figure, 1,60,000. Okay. And K. Debt, what was the rate? 8.33%. Preference rate was what? 11.56%. And 11.96. 11.96. 11.96%. And equity share capital, now we have calculated 15.9%. Amount multiplied by K. Amount multiplied by K. Please give me the figure. This is already there. 30,000 to 8.33. How much? How much? 2,700. Okay. And I can't hear you. Someone else. 2,500. Yes. 2,500. Next. 1196. Next. 440. So take the total. 29. 136. 136. 1,60,000, 1,70,000. This is 2 lakhs. Same. Okay. Now calculate the this thing. MCC. 29,136 divided by 2 lakhs. How much it is? 14.56. 14.56% is MCC. Okay. Please copy this from here. Have you copied this part? Those who have not, please copy.
Yes, sir.
Okay, done.
Sir?
Yes.
So only large
Huh.
shouldn't only weight be considered, like why are we writing weights? So that's no logic.
What we should write?
Sir,
Yeah, correct. Yeah, that is right. Means you can use the weights also, but weights we have not calculated, na. Or the pattern will change, na. Again, people will feel that, array, somewhere you are using weight. People have that mindset also. Sometime amount, sometime weight.
Over saying it because the rate
Is same.
from that
Correct.
is not given.
Instead of amount, she is saying that you should calculate you should take the weight, right? Okay, done.
Sir?
Yes.
So what will happen if the face value of the share is increased?
Face value.
Yes, sir.
Acha.
They have given 20 rupees into 10,000 shares.
Where? This part.
No, sir. In the question, they have told assuming new equity is issued at 20 per share, right, sir?
So that is
So
not
there are
face value.
10,000 shares.
That is not face value. That is not face value. What is 20? He is saying that 20 is market value or issue price. Or issue price. Means you can assume, question is not clear. If you want to dig it, then you can say that 10 rupees is the face value and 10 rupees is the premium. Correct?
Okay, sir. What will happen if it is multiplied by 10,000?
What will happen? Number of shares, issue price multiplied by 10,000. What you will get? 10,000 multiplied 20 is asking what you will get.
Amount raised.
Amount raised. I am issuing
Why
one
is that
share for
not
20
taken into
rupees.
consideration?
Huh?
Why you did not consider that amount for equity share?
I considered that only. Means I am not considering 20 rupees. I have considered in KE. See, KE I calculated now. That is based on that. Understand? I have considered in KE. Okay. What he is saying, he is saying that whatever is the number of shares issued now, I don't know the first thing, the number of shares. Please understand. If they would have said na, listen carefully, if they would have said additional fund 10,000 is issued, 10,000 or 10,000 shares, then I would have added that here. Is that clear in this? And that too multiplied by 20 or the face value. If I am taking all this as book value, then you should multiply by 10. If all is at market value, then you should multiply by 20. Understood? Means question is not clear that 20 is market price or the issue price. Let us say issue price. So then you should multiply by, because 10 will be securities premium, na? Right?
Yes,
so you should multiply by 20 like that. Understood? Is it clear? Write the heading. Capital structure theories. Write the heading. Capital structure theories. Okay. Now listen, it is very important. Okay. So listen carefully. Now what the theory has to, this all theories has to say. Now what the theory talks about, these all theories, they talk about first thing is debt equity mix. Debt equity mix means what? Weights. Weight of debt, weight of equity. Understood? Like previously I said na, the proportion is same. Means they are assuming that all are, means weights are not changing. Like this here also, some of the theories assume that the weights are constant. Means debt equity mix is what? Same. So means some theories assume, means what the all the theories they are talking about. What are the variables I am discussing? What are the variables that is I am discussing? Debt equity mix, then cost of each component. When I say cost of each component, means I am talking about what? Please say.
Individual cost of capital.
Individual cost, KD, KE. Understood? They are talking about that. Then overall cost, that is WACC they are talking about. And from this WACC now, we can get value of the firm. They are talking about the value of the firm. So all these variables they are talking about. Now what is the objective? What is the objective? Objective is to choose that debt equity mix to choose that debt equity mix where the WACC is what? The WACC is what? Minimum or maximum? Minimum.
Minimum.
WACC is cost, na? Weighted average cost. Cost will be minimized. Value of the firm will be maximized or minimized? Maximized. Please concentrate and participate. Listen. That debt equity mix, that proportion should be used where the value of the firm will be what? Maximum. Your cost will be what? Minimized. Is it clear?
Yes, sir.
Value of the debt is equals to, how you calculate value of the debt? Interest upon KD. Interest upon KD. Please understand. Interest is an amount. Okay, obviously after tax, let's say. Now here I'm not considering tax because I'm generally loosely I'm writing this. Why? Because they say, we will do assumption. They say that there is no tax. There is no corporate tax. When tax is there, when the tax will be considered, we will think about that. But for the time being, interest, you will not do 1 minus T. You will just take interest. Tax is not there. Corporate tax is not there. Is it realistic?
No, sir.
No, sir.
But still they are assuming. Okay, listen. Value of equity will be what? EBT or Hitesh? Or Hitesh, what is the assumption? When I say EBT is equals to Hitesh, what?
There is no tax.
There is no tax, as well as there is no preference also. As well as there is no preference also. So divided by, I will do KE. Now when I divide any amount with its percentage, it is called capitalizing. What we call capitalizing. This is the income. This is the income of equity. I am dividing it by the percentage of income. So I am capitalizing. Understood? This is the income and I am dividing it by income rate. The rate of income, cost for the company. So what? I am capitalizing. Please copy this. Value of debt is interest upon KD. Okay. And value of equity is what? EBT or Hitesh divided by KE. Hitesh is what? Earning available to equity shareholders. Earning available to equity shareholders. Done. Think and tell me. I want to calculate the value of the whole firm. What will be the numerator? Tell me. For the whole firm, what is the earnings?
Capital employed. Capital employed.
EBIT. EBIT is earning for debt as well as what? Equity. Yes or no? Divided by which rate?
KE.
KO. KO,
No,
na?
KO.
M-
KO,
Yes, sir.
value of the firm. Overall value of the firm.
MC.
Is it clear? Understood?
Yes, sir.
Alternatively, please write value of debt is equals to value of equity plus, value of firm is equals to value of equity plus value of debt. Very interesting part, this of capital structure, very important. Or unrealistic assumptions, still we are doing it. Okay. Copied?
Yes, sir.
Listen carefully. I am summarizing the thing, giving you overview, what are the theories, so that we can have a good knowledge. Listen, what I can do is, see, debt equity, I am writing in shortcut, I am not giving theory. Because anyways, in sums now, altogether, something different you have to apply. Debt equity changes, then debt equity if changes, then WACC also changes. WACC also changes. Delta means change. Delta means what? Change. That triangle means change. Debt equity changes. Understood? If the debt equity changes, then what? WACC changes. This theory, who support this saying? Who support this saying? Two people. That is net income approach. Second one, traditional approach. Second is what? Traditional approach. Okay. Then some people, what they say, some theories, what they say, they suggest that if you change the debt equity, whatever whatever may the proportion, then WACC is constant. Then WACC is constant. Understood? This is set by whom? First, net operating income approach. Net operating income approach. Second, Miller and Modigliani approach, or Modigliani and Miller approach. MM approach. MM approach. MM approach. We will write in detail later. MM approach. So this you should summarize. Summarize. Are everybody, are you understanding what I said? First part says if the debt equity changes now, debt equity changes, the mix proportion changes, then your WACC gets affected. Means your WACC will change. Whether it will go up or down, that is a different issue. Understood? Who says that? Who says this thing? That WACC gets affected because of debt equity? Two approaches, net income approach and traditional approach. WACC does not get affected, whatever may be the proportion, whatever debt, equity, whatever may be the proportion, WACC does not get affected. Which approach? Net operating income approach and what? Miller and Modigliani and Miller approach, MM approach. Is it clear? Copied?
Wait, sir.
Wait, sir.
Okay, please copy. Done?
1 minute.
Now think and tell me. Completed, na? Okay. See what they are saying. The general assumption for all the theories is same. They are saying that it's a going concern. Means going concern concept is applied. Means it's the debt and your equity has a perpetual life. Is that clear? First assumption, perpetual life. Means what? Going concern. Okay. There are only two sources, equity and debt. That means what? What is not there? What is not there? Equity and debt is
Preference.
preference is not there. Very good. And what they are saying, total amount of capital employed now, it will remain same. Means proportion might change. When I say proportion might change, it means what? And the total capital employed is same. Means what? What does it mean?
Weights are changing.
Weights are changing. But total let's say 10 lakhs. 10 lakhs. I have issued the total capital employed is 10 lakhs. So what will happen? If I am issuing the debt now, that means I am buying back equity. If I am issuing the equity now, I am redeeming the debt. Isn't it?
Yes, sir. Yes,
Then
sir.
only it is possible, na? I hope everybody is understanding what I am saying.
Yes, sir.
Understood, na? If the total amount is 10 lakh and if you are issuing the equity, that means you are repaying the debt. So that overall 10 lakhs, the amount remains same. If you issue 2 lakhs equity, you are redeeming the debt by 2 lakhs. And if you are borrowing 2 lakhs, you are buying back equity. Okay. And what they are saying, very unrealistic assumption. What they are saying, that business risk na is not affected. That is, there is no change in the fixed cost or the operating risk, operating leverage. There is no change. That is correct. Okay. This is a bit realistic. Now, what they say about operating profit, that it will constantly grow. Now, this I don't think is a realistic. EBIT and IBIT, operating profit, it will constantly grow. The main assumption is there is no corporate tax. Is it possible? There is no corporate tax. There is no preference dividend. Understood? And there is all the investors now, all the investors, whether it is debt, whether the investors are bond holders or whether the investors are equity holders, everyone's expectation is same. Can it be?
No, sir.
No.
Sir.
Cost of debt now one realistic assumption. Cost of debt, that is KD now, will be less than KE. Agree? Debt will be
Yes.
cheaper than what? Equity, always. And it is true. Okay. Fine. Write the heading. Net income approach. Write the heading. Net income approach. net income approach. Now I have given you the theory and all in your book. Okay. Now what does this theory says? You know, this theory says borrow maximum possible amount. Maximum possible. I am giving you shortcut. Borrow. Please write. Borrow maximum debt. Okay. WACC should go down. Means what? Minimize the WACC. Minimize the WACC. And hence value of the firm should increase. And hence value of the firm should increase. Please understand. Very shortcut to understand. Borrow so much now. Borrow so much that your WACC should be minimized. And value of the firm should be increased. Correct? Maths. If this denominator goes down, value of firm will increase. Agree or not?
Yes, sir.
Yes, sir.
The chaotic
Yes, sir.
denominator goes down. Minimize means value of firm what? Increase. What they are assuming, you know, they are assuming that return on capital employed is greater than the cost of interest. What does this mean? Which phenomenon is applied?
Trading on equity.
Trading on equity.
Trading on
Very
equity.
good. Trading on equity. TOE is applied. Understood? Trading on equity. Is that clear? Please write all these things. I am giving you shortcut so that if theory questions come now, you can attempt. Anyways, sums has nothing to do with this. Next, listen. One main thing. They are saying that KD and KE are what? Are constant. Are what? Are constant. Is that clear? Okay, are constant. This is what they are saying. Okay. And they are saying maximum use of debt you should do. Now listen carefully. Let us directly jump to the sum and let us see what they are saying is correct or not. Okay. Come to question number this net income approach. Page number is 272. 272. Question number 51. 272. Question number 51. I am reading out. KD is equals to 12%. K is equals to 25%. Total value of the debt is 20 lakhs. Operating income. When I say operating income, what it is? EBIT. EBIT is how much?
EBIT.
15 lakhs. Calculate the total value of the firm as well as market value of equity. Okay. Also calculate the overall cost of capital. I will stop here. Let us go slow. I will stop here. I am not reading the further part. Listen. KD is given. KE is given. Operating income is given. Value of debt is given. Okay. Can I calculate Hitesh? Can I calculate Hitesh? Yes or no?
Yes, sir.
Yes, sir.
Yes. Listen.
Yes, sir.
Listen. Then you can copy. Listen. Question number 51. Okay. Tell me, how much is the EBIT?
15 lakh.
EBIT, operating income is 15 lakhs. Is there any debt? Interest?
Yes, sir.
How much?
12%. 12% of
12% of what?
20 lakh.
20 lakhs.
How much it is?
20.
2 lakh.
2 lakh
2 lakh
40,000.
40,000.
So answer is how much? EBT, or you can call this as what? Hitesh. Because what is the assumption? There is no preference. Okay, and there is no tax also. So Hitesh is how much? 13 lakh, 12 lakh
12 lakh 60.
60,000. Please understand, 12 lakh 60,000. Understood? How we calculate the value of equity? Listen, Hitesh divided by KE. Is the KE given? Check.
Yes, sir.
KE is how much?
Yes, sir.
25%.
25%.
25%. Give me the value of equity. Give me the value of equity.
50 lakh 40,000.
50 lakh 40,000. Listen carefully, then you can copy. Please listen. Very important. Value of debt is also given. Check. Value of debt. How much it is? 20 lakhs.
20 lakh.
20 lakhs. So what is the value of firm? Value of firm. In exam, they call this as S. I don't know why, but they call this as S. They call this as D. Value of debt D. And this they call as V. Okay, so S plus D is equals to V. This is the notation used. So value of the firm is how much? 70 lakh 40,000. Understood? Is it clear? Okay.
Yes,
What
sir.
they are saying? Total value of the firm. Total value of the firm we have done. Net income approach. What is the logic behind the name? Net income approach. Are what is net income? EBIT? EBIT or Hitesh? What is the net income?
EBT.
Are what is the net income? I'm not saying operating income. What is net income?
Hitesh.
Hitesh. So I started with Hitesh. Hitesh divided by KE. Value of equity plus value of debt. Value of the firm. Understood? So value of the firm as well as market value of equity that we have calculated. Market value of equity is 50 lakh 40,000. Also calculate the overall cost of capital. How we calculate the overall cost of capital? Calculation of WACC. Calculation of WACC. Same way as we did. Source. How much percent? 12% debenture. 12% debenture. Amount is 20 lakhs. Amount is 20 lakhs. Cost K is how much? Tax is not there. So KD is 12%. Amount into K 2 lakh 40,000. Then equity share capital 50 lakh 40,000. Correct. Multiplied by how much is the cost? KE 25%. Please give me 25%.
12,60,000.
12 lakh 60,000. Total 70 lakh 40,000 divided by sorry, what is the total? 15 lakhs. Correct. 15 lakhs. So
15 lakhs.
WACC KO is equals to 15 lakhs total cost divided by 70 lakh 40,000. Tell
Yes,
me the
sir.
WACC figure. Tell me the WACC figure. How much it is? 15 lakhs divided by 70 lakh 40,000. 20?
21.20%.
21.31. Okay. Now please copy this. Copy this from here. Please copy.
Done,
Done?
sir.
Okay. Listen. Now what they are saying. Let us.
1 minute, sir.
Okay.
Yes, sir. Done, sir.
Okay. Now see, listen. What they are saying in the question, I'm reading it further. Show the impact of change in capital structure on the value of firm, as well as overall cost of capital. Will the WACC change? They are asking us where the total amount of debt is increased by what? 10 lakhs, which is utilized to reduce their equity. See, you issue the debt, means you borrow debt and redeem what? Sorry, buy back what? Equity. You reduce the equity. So overall amount remains the same. Is it clear? So listen carefully. Right. If additional debt of rupees 10 lakhs, please write with me, 10 lakhs is issued. If additional debt of rupees 10 lakhs is issued, calculation of Hitesh, EBIT is how much? 15 lakhs. Correct. This time minus interest. Interest will be on what amount?
10 lakh.
30 lakhs.
30 lakhs. 20
Yeah,
lakhs
30
plus
lakhs.
10 lakhs, additional 30 lakhs into what is the cost of debt? 12%. 12% is how much? 3,60,000. So my EBT or Hitesh is how much? EBT or Hitesh is how much?
11,40,000.
11,40,000. So again, value of equity is equals to 11,40,000 divided by K is how much? K was how much? 25%. So answer is how much? 40, 80, 160, 160, 44. 45 lakh
4560.
60. 45 lakh 60,000. Value of debt. This time value of debt is how much? 30 lakhs. So answer is how much? 75 lakh 60,000 is value of the firm. Value of the firm is 75 lakh 60,000. Please copy. Please copy. If you remember, what I said was, in the theory, check in the theory, KD and KE, will it change or will it remain constant?
Constant.
Constant.
See here. After issuing the debt also, KD was 12, KE was 25, constant. In the second calculation also, we took 12%, we took 25%, it was constant. I will calculate WACC. Calculation of WACC. Source. Amount. Cost. Amount multiplied by cost. Debt. 30 lakhs into 12%. 3,60,000. Equity. Equity is how much? 45 lakh 60,000. 25%. 11 lakh 40,000. 75 lakh 60,000. 15 lakhs. WACC. 15 lakhs divided by 75 lakh 60,000 is how much?
19.84.
19.84%. Please copy. 19.84%.
You can just write EBIT divided by value of firm now.
EBIT divided by value of firm. That is what I have to prove. Okay.
So
That
we
is
have
what
to
I have
prove
to.
that. Okay.
They have asked us to calculate WACC. So this
Huh,
is what I have to
we
show.
have given the formula already. So I was just asking why to do the calculation. Can't we just directly do it?
No, you will have to show, na. They are asking us to show the changes.
Okay, sir.
So you'll have to do. Did the WAC change? WACC.
Yes, sir.
Yes,
Increased or decreased? Increased or decreased?
Decrease.
Decreased. Debt increased. The trading on equity applied. Value of the firm, is it increased? Initially it was how much? 70 lakh 40. Now it is how much? 75 lakh 60.
75,50,000.
Correct, na? WAC decreased. That is what we learned. That is what we learned. Okay. Right. Write the final answer. Is it okay? Done? Should I explain? Right.
done.
With the change, with the change, with the change in debt equity mix, with the change in debt equity mix, semicolon, WAC went down, WAC down, KE and KD same, okay, and debt increased, and debt increased, and debt increased. With the change in debt equity mix, WAC decreased, KEKD same, that is constant, and debt increased. Done. Write the heading. Net operating income approach. Net operating income approach. Net operating income approach. What they are saying, you know, they are saying that in this approach, acha, in the table which I gave you, na, shortcut, in that check, this overall, the overview, check what this approach said. Debt equity mix changed, WAC changed, yes or no? Correct?
Yes.
Yes, sir.
Which approach? Net
Yes,
income
sir.
approach. Which approach? Net income approach. Hence proved. Correct? Coming back. Numbers is our strength. If you don't understand the theory, you should go to the numbers. Net operating income approach says what you know. What it says that KD na KD, debt capitalization rate, KD remains constant at various level of debt equity mix. However, as the debt increases now, what it says, as the debt increases, the expectation of the equity shareholders will also increase. So K increases because their risk increased, more practical, yes or no? Understood? As the debt increases, now K will increase. But what this people is saying, you know, listen carefully. Now, what happens? The debt increases and debt's cost is low. Debt's cost is low. Because of that, the interest will have tax savings. Yes or no?
Yes,
Correct, na?
sir.
There will be some savings because of debt. That is trading on equities applied. That savings na is offset. That savings is offset by the increase in cost of equity. You understood what I said? That is called set-off effect. What it is called? Set-off effect. Means increase in the financial risk causes the cost of equity to go up. Debt increased, financial risk increased, cost of equity went up, but there was a fight because of debt. The interest cost is low, so there was a saving. Whatever the cost has went up in equity, that got set off. Is it clear? That is one of the assumption. KE na KE, they are saying that, sorry, not KE, they are saying that KO is constant here. What they are saying? KO is constant. Please understand. Okay, KO is constant. Why KO is constant? Because it is offset, na? KD went low. It is minimizing your cost. But KE goes up. There was a fight. It set off. So KO is constant. Overall cost is constant. Is it clear? Understood?
Yes, sir.
Clear, na?
Yes, sir.
Have you understood that what I am saying? Because of debt, there will be tax savings. Because when the debt increases, there will be more tax savings. So there is some savings. But the cost of equity has went up. So they are saying that it will offset each other. Okay. If they are saying that, what they are saying, that since WACC WACC is constant. WACC is constant at all the level. Means because your overall cost is constant, whatever the debt equity mix may be, okay, it is the optimal capital structure. What they are saying, every debt equity mix is optimal capital structure because it is already minimized. How the graph will look like, if I want to make a graph, this is debt equity mix here. Okay, this is debt equity mix, different proportions of debt equity. And here let's say cost of capital is there. Cost of capital is there in percentage. Cost of capital, KD, KE and all is measured. What they said, remember, will the KD change? No. KD will be constant. KD will be what? Constant. Will the KO change? No. Overall cost is also what? Constant. KE will remain same or will rise?
Right.
As the debt increases, KE will what? KE will go slowly, it will rise like this. Slowly it will rise like this. This is the graph. If you want, you can draw. If you want, you can draw.
Done, sir.
Overall, this theory states what? What does this theory states? KO is constant. See the summary, what we made the table now. Whenever the debt equity mix changes, WACC does not get affected. That is what it is saying, na? Overall, yes or no?
Yes,
Understood?
sir.
Okay. Listen carefully. Come to the sum. Come to the sum. Sum number. 52. 52. KD is how much? 12%. Value of the debt is how much? 20 lakhs. Operating income is how much? 15 lakhs. The firm's rate of return on its capital employed is what? 20%. ROCE is 20%. Understood? Underline that. 20%. Underline. That is KO. That is what? KO. Overall cost of capital. Right? The return generated on capital employed is cost for the company. So KO. Calculate the total value of the firm as well as the market value of equity. Also calculate overall cost of capital. Okay, we will stop here. Like previous sum, we will stop here. So KD is given, value of debt is given, operating income is given, EBIT. And what they are saying? They have given us KO. Okay. What is the approach name? What is the approach name?
Net operating cost.
Net
Income.
operating income approach. Net operating income. So this time we should start with what?
Operating income.
EBIT.
Of EBIT, operating income. Listen what I said. Now calculation of Hitesh. Calculation of Hitesh. EBIT is how much? This is general calculation which we did in the last sum also. EBIT is how much? 15 lakhs. Same. Minus interest is how much? Interest is how much? 20 lakhs into 12%. 2,40,000. So Hitesh is how much? 13 lakh, not 13 lakh.
12 lakhs.
12 lakh 60,000. Please copy. Please copy. See, listen what I am saying. This is net operating income approach. So this time we will capitalize what? Operating income. Operating income means EBIT. EBIT will be capitalized by what? KD, KE or KO?
KO.
KO. When I divide it by KO, what I will get? Value of the firm, value of the equity, value of the debt. Value of the firm, great. Value of the firm. Hence the name is what? Net operating income approach. So EBIT is how much? 15 lakhs. And divided by 20% is KO given in the question. 20%. How much it is?
75.
75 lakhs. Okay, 75 lakhs. Copy. Go slow. To get the value of equity, I should add value of debt or I should deduct value of debt.
Deduct.
Deduct value of debt. From overall firm value, I will minus the debt. So remaining is what? Equity. Equity plus debt is firm's value. Equity plus debt is firm's value. So minus value of debt. How much was the debt? 20 lakhs. So 55 lakhs is what? Value of equity. Done.
Yes, sir.
Can I calculate KE? Can I calculate KE? Yes. Can I calculate KE? What is the formula? Say. Hitesh.
Divided by value of equity.
Value of equity. Hitesh is how much? 12,60,000. 12,60,000 divided by. Why I am calculating this? Because I have to calculate overall cost of capital. For that KE is needed. Answer is how much? Hitesh divided by value of equity. Please write. How much? Please say.
22.90.
22.90.
90.
Yes,
It's
sir.
a 909 it will come. 91 you can take.
91. Okay. 22.90. 91. 91. Okay. 91. Next, listen. Calculation of WACC. Calculation of WACC. Source. They have asked us to calculate. Amount. K. Amount multiplied by K. Debt. Debenture. 20 lakhs. Rate is how much? 12%. 2,40,000. Equity. 55 lakhs. 22.91%. Answer is 12,60,000. Same amount you take. 75 lakhs total. This is 15 lakhs. WACC is how much? 15
20.
lakhs divided by 75 lakhs. How much?
20.
20%. 20% is WACC.
Sir, what's the point of asking the same thing which is given in the question?
That
Because
is
we
what we are
calculated-
doing. Let me complete the question. That is what we are doing. Wait. I understand. But they have asked us. So we are doing it. They have asked us to calculate the WACC. Okay. And I want to prove this next point. That is when the debt increases. Okay. So I have calculated. I understand. This is a number game. Understood.
because
We are going
KE
round and round and round. I agree with you. We are going round and round and round. What she mean to say is, sir, you calculated the debt amount with the percentage. Understood? Here, above. And I tried to calculate the means value of firm, then value of debt, value of equity. Again, I am doing the same thing. I am multiplying this with this. Correct? And then I am adding the value of debt. So ultimately what happens? It will give me the same cost. Same value of firm, same cost. Correct? Next, listen, done. Second part, I am going to the next part. What they are saying. See, listen. Also, calculate overall cost of capital and show the impact of change in the capital structure on the value of the firm as well as KO. when the amount of total debt increased by 10 lakhs, and that will reduce what? Their equity. Their equity again. So let's start. If the additional debt, is rupees 10 lakhs, additional debt is rupees 10 lakhs. Okay. EBIT, how much it was? 15 lakhs. Minus interest, 30 lakhs into, will the KD change? Will the KD change?
No, sir.
Cost of debt will not change. It will remain 12%. So 3,60,000, 12,40,000.
11,40,000, sir.
11
lakh 40,000.
40,000. 11,40,000 is Hitesh. 11,40,000 is Hitesh. Value of the firm, net operating income approach. EBIT upon KO. EBIT is how much? 15 lakhs. Upon KO is how much? 20%. So answer is what? Rupees 75 lakhs. It will be same because the EBIT didn't change and the KO is constant. Minus value of debt is how much? 30 lakhs this time. 30 lakhs. So value of equity has changed. How much? 45 lakhs.
45
This is what
lakhs.
I wanted to show. This is what I wanted to show. Can I calculate KE? Yes. KE is equals to Hitesh. Why I am solving the sum? To show all these things. Divided by value of firm. Hitesh is how much? 11,40,000. Divided by value of equity. Sorry, not firm. Value of equity. Please correct it. Value of equity 45 lakhs. Answer
25.33%.
25.33%. Initially it was how much? This has rose. Initially it was how much?
22.91%.
22.91. See, that is what I have to prove. So cost of equity increased with the increase of debt. But the tax savings and the increase in the cost of equity will fight and there will be set off. So the overall cost will remain same. Again, calculation of WACC. Source, amount, K, amount multiplied by K. According to Sammy, they should not give the theory only. Why? Because there is no point. Understood? Correct na?
Yes, sir. We are doing the same thing again and again and again.
But anyways, we will
Sir,
fetch
it's like
some
we are
marks.
just moving in a circle.
Yeah, that is what I'm saying. 30 lakhs. But see now, people have derived so many silly things. They have made so many assumptions. Still they are famous. And we are working so hard. Okay, to be famous. 12 lakh, 3,60,000. 45 lakhs, 25.33% will be how much? 11,40,000. So total value is 75 lakhs divided by 15 lakhs. Again, someone will say, sir, what you are doing? It's same. Yes, it is same. That is what I have to prove. In spite of the debt increase, in spite of the equity went down, the WACC is still what? 20%. That's it. Understood? That is what the theory says.
Sir, can you scroll up a little?
Yes. Fine.
Sir, in exam, a theory question should come, sir.
This question will
I mean, in exam, theory question should come, sir.
theory question.
Yeah.
Why?
Yeah, I mean, sir, we have to just roam around and get the same answer again.
Done?
Yes, sir.
Everybody completed?
Yes, sir.
Listen, I
Yes, sir.
forgot to give you the diagram of the net income approach. I don't think I have given the net income approach diagram, right? Please make it somewhere now, please adjust it. Net income approach. Please make a diagram, net income approach. See, you think and tell me. You think and tell me. KD will remain constant or it will change?
So both are constant.
Constant.
KD is also constant. K is also constant. And KO?
Changes.
KO changes.
Change. But
Falling.
changes means what?
It decreases.
KO falls. What? KO decreases.
Decreases.
Very good. So diagram will be something like this. You can also make diagram. KD. Here what? KE. Debt equity mix. And here what? Cost of capital. Done. Okay. That's it. Those two
So-
sums now I did this sum so that you can understand the theories. Is that clear? There is chance that they might ask that what happens and all. Generally they are interested in arbitrage, which we are going to do. Say what?
So the KO line should touch KD, no?
No, it will not touch. It will not. Means it will be constant, but it will not touch. There will be some difference, na?
No. It will touch KD when the entire capital itself is dead. So there is no difference between KD and KO, na?
And if there is no difference, then where the KE went? Cost of equity
Arey,
will be there, na?
That's what I'm saying. If there is no equity, there's only debt in the capital.
Then correct. That we are going to do. You don't say there is no debt. You say there is no, sorry, you don't say there is no equity. You say there is no debt. That company will be available, public limited. Where what we call when there is only equity?
Unlevered.
Unlevered companies KO.
Unlevered.
Unlevered companies KO and unlevered companies KE is same. That is what we are going to do next class. Okay?
Okay.
Fine. Okay. Let's stop here.